This is a great panel. A bunch of liquid venture investors in crypto.
Just liquid.
Just liquid, sorry. We discussed this backstage, the terminology and how people like to be addressed. Liquid fund managers. I'll let you guys introduce yourselves very briefly.
Hi, I'm Jordi Alexander. I run Selini. We do liquid, venture, a bit of everything.
Hi, I'm Jason Kam. We operate out of Asia since 3.5 years ago. Our book is 70% liquid and 30% private.
My name is Zaheer Ebtikar. I'm the founder of Split Capital. We're a full liquid fund.
Okay. And for, I guess, background, earlier, previous in my career in crypto, we ran a hedge fund, so I'm going to be a little bit tougher on you guys than the average moderator about strategies. So let's dive into, we'll dive into just that. So I say liquid venture, I get thrown back at me liquid. I say the word venture, people don't like to identify that way. What is, in 2017, for example, all of the vintage funds that were a part of my old firm and others were liquid funds with a small to large side pocket of private investments. Has that hedge fund or liquid model changed more recently? And why do you think that is the case? And what's your perspective on that model versus a purely liquid model with outside pockets and privates? Whoever wants to take it. You're pure liquid, so we'll start with you.
Yeah, I think there's two things. We learned very quickly, or I guess across a few years, but relatively quickly as an asset class, that we don't have a real fundamental basis for a lot of tokens in crypto. And as a result, a lot of the fundamental kind of liquid venture funds have now started to either die out because of performance or because the strategy no longer makes sense and like you can't really make sense of the math. And so now there's more of a kind of push towards, you know, what we like to call like a long-short model or prop model for liquid markets, right? So this is much less dependent on just pure fundamentals, much more dependent on market dynamics, flows, things like this that are quantifiable that you can actually see in the data. And I think that's also why there's more and more of this kind of trend happening.
So counterpoint, sorry, I'm going to let everyone go, but so then why are the largest liquid funds in our industry long biased, primarily long only?
Yeah, I think this really comes down to the fact that it's a legacy model.
Yeah.
When LPs deploy capital into funds in crypto, the duration generally, you know, even if they have no lockup or a lockup or not, like the duration is usually multi-year, right? And they don't really want to think about redeeming capital out of a fund and redeploying and doing this whole thing. So a lot of this really comes down to the fact that this is a legacy model back from 2017, 2019, 2020, 2021, these years, the golden years of crypto, and the existing LPs into these funds won't write more money, but they're like, we'll just keep it in there. We'll let whatever happens. And that's kind of what, like they did really, really well when it's zero interest rate, right? $4 trillion of liquidity pumped into markets, and crypto is kind of coming out of its shell in 21, but now it's no longer the case.
Cool. And then just kind of to frame this out, we're going to talk about strategy first, then maybe underlying infrastructure that allows you to deploy certain strategies and manage risk, and then we'll get into the fun stuff of what this new regime is and what you guys are investing in. So let's go into it with that mindset. Same question to either of you guys, the structure of today versus 17, which sounds like you're kind of still there with Folius.
Well, we launched as a hybrid model because a lot of returns in crypto actually came from tokens and not equity exit. That might change in the future when the NASDAQ market opened up. We also did it because it's kind of an unspoken hack within crypto where you do a seed round. The time from creating a team and raising capital to launching a TGE is like 6 months. And there was a point in time when you get unlocks at TGE and you can sell everything in 6 months. That was also a time where there wasn't a lot of projects out there. So any company with a half legit team actually gets a lot of mind share, and with the low float, high FDV dynamic, you get a huge, valuation. So that was a time where you can do a seed deal at 5 million and then you exit at, like $5 billion or something. And that was the game between 19 and 2023. And that was also the time where VCs go around and showing huge TVPI, right? 10 times, 20 times, 50 times. And the LPs see no DPI, but they're like, oh, this is fucking huge. This is great. But that doesn't really work anymore as the dynamic completely changed in the market. There are a lot more projects. A lot of them get listed. Nobody want to buy that shit. And there's no value capture. So, and the lockups generally have gone from maybe like immediate investing to like over time, one plus three, 1 year cliff plus 3 year vest. So that model is broken. And I think going forward, venture will be just, probably a Alliance DAO type model. Or maybe like a, Sequoia US type, multiple rounds of leads, 10-year horizon, like the old way of VC. So I think we're going to go through a full cycle where a lot of funds will go liquid, like we do now.
Do you think it's healthier for, so I have this debate a lot with a lot of folks, and I'm more on the venture side, but I always think about liquid markets because your job is to return money to investors. Longer cliffs investing schedules, net benefit for the market and the project or net detriment? So I'll give you my opinion. I think it's smarter to get quicker to market with more of your supply and have a force of your cap table around you to support that than to drag it out over multiple years. Because those tokens are your incentive for your community.
That's probably right. I think the issue is not how long or short the vestings are. It's just the projects were founded with the goal to do TG and dump it.
Yeah.
I don't think amount of vesting
is going to... I always found to dump it.
I think maybe 95% of projects are doing it that way. And then they kind of put on a facade of shipping, but in reality, they're just done after TGE. And hopefully, I think the industry changes with a real path to value capture in the US landscape. But I think there's a lot of debt we have to pay into the future for that.
And Jordi, how has your model evolved?
No, I mean, I agree that this 1 plus 3 year model, when the main product market fit of a lot of projects is just the TGE and the price discovery around that, and is it going to trade at 3 billion or 1 or 2, and then a year later, it's just this unlock forever thing. I'm a huge bear on these unlock schedules. I've said it. I think generally it creates the forward expectation is always negative because there's always more and more supply coming in.
Yeah.
There's a few cases where it's worked, where by the time they come in, things are growing and then they kind of absorb.
Yep.
But it's very different than, I guess, a few years ago where people were, I guess, not so bifurcated on TG and then the long term.
The unlocks were contraindicators. The unlocks were typically bullish.
Yeah.
Bullish
unlocks. I have not heard that phrase in a while.
Yeah. Okay. And then, so now we'll step into kind of your strategies. At some form of that is research, data-driven and otherwise, then risk management. Some form of that is your trading systems, your GUIs. How has that progressed? Custody in 2017, you guys remember, it was air gap devices in tamper-proof bags and Faraday cages. And now we have, regulated custodians. So in terms of your specific strategies, how do you inform your investments, your investment research? What matters, right? Does transactions, wallet addresses matter, or do flow of funds matter more? And I think we all generally know the answer to that. And then in terms of risk management, this is an opportunity to kind of shout out some of your favorite service providers or something you've built internally. A lot of people, again, we had to build out our own back and middle office, right? Technically. So feel free to talk about any part of your stack that you think has gotten significantly better and allowed you to invest and perform better, and then where you think there is a glaring gap in the market.
I mean, you definitely don't want to have a lot of friction. If you're going to find something on chain, you just want to be able to buy it. We use 4DeFi. That's our MPC solution. It works really well. It's quick, nice, easy, safe. I remember, it used to be really bad. So that's gotten better.
And you have a market-making business too, right? As a part of it. Does that change how you interact with the market versus a straight-out hedge fund like us? Because we have, with Fireblocks, with Anchorage, we use central exchanges, we use prime brokers, which really developed over time, Galaxy, FalconX. But I feel like you guys do something a little different, at your setup.
I mean, like I said, 4DeFi is our main solution. You can just make as many vaults as you can. I saw we just had Evgeny on from Wintermute, and because they don't make as many wallets, they just have a couple big wallets. So everyone sees the big Wintermute wallet and tracks it, and then they're selling, they're moving from Binance. We like to just have hundreds of wallets. No one knows what's going on.
Yeah.
And Yeah, we sleep better at night that way. Yeah.
I guess we're more discretionary long short. We long biased. I came from TradFi, so it's a good way to underperform the market because a lot of what happens here is flow and mind share versus like what actually happens underneath. Most of the time, what happens underneath is not enough to drive the prices. But for me, most of the time, is it a good business? Is it a good founder? Does it capture revenue? And then in the end, did they give a fuck about token holders? And is there a lot of unlocks? When the stars do align and when it's a lot of mind share aggregating onto this name, it usually tends to outperform. But in the end, it might not even outperform Bitcoin. But we have a small alt basket there.
So does that culminate in you having conversations with other fund managers and project teams? Or is it more you're monitoring particular data points, or is it all the above? Is it, traditionally if you're doing equity research, you talk to the management team, you talk to the sell side research analysts, you look at, market, you call your trading desk and say, what are you seeing in flows?
Well, it's talking to you beautiful people as far as ideas. and sometimes we pick up stuff. It's like Jordi tells me this guy's an absolute scam. So we'll figure it out. I created a service called bitclub.io, BIDCLUB. I'm shilling it. You can check it out. Yeah. It basically has a lot of secondary market liquid thesis on there, so I get better sourcing. But it's the same process. You bring a management team, you build a model, you figure out the token investing, you figure out who's dumping, and then you underwrite a thesis. Yeah. To be fair, it underperforms pumped off on coins, and it underperforms the cabals, and it underperforms all the bullshit, which is a little disheartening. I don't know.
Yeah.
The biggest thing missing in crypto markets for efficiency, I think, is so basically the amplitude between the lows and the highs is completely unnatural from anything else. And I understand part of it is because we don't know the fundamental DCF analysis value of a token. But really, you just get these constant, it goes up 10x, goes up 98%. These things are insane. And I think, as liquid traders, liquid managers, liquid strategists, the biggest low-hanging fruit is keeping cash to just deploy into these absurd dips we get. The dips are just way too deep. And then just being not as greedy on the upside, smoothing out a little bit this absurd amplitude. And it's trading 101, buy low, sell high. It's still...
That's what we're talking about back. Very simple. So on the having cash to deploy, as a fund manager, you're always thinking about being efficient with your balance sheet or maximizing your capital base. Does that mean sitting in cash? Does it mean having a super USDC vault that's yielding you something while you wait? Or is it leveraging options to have risk replacement where you can have exposure and still maintain a cash balance? What are your guys' general views on cash management and strategy?
Yeah, it really depends. Right now, rates are pretty down bad across the board. You should still be efficient with your balance sheet as much as you can, obviously. But there's also, the big thing is always the payoff, right? If I'm getting 3% on cash that I have outstanding, what's the point? Within reason, because now I have a bunch of smart contract risk, or I have a bunch of counterparty risk if I don't like my counterparty. Now it's gotten better. Now there's better primes and stuff like that. But I think it just really is contingent. Crypto market neutral is a really funny world where it's the yields get really, really good when the price goes up a lot, obviously. So then you're kind of well, why am I even doing this? If, Bitcoin's implied as it's going to double in a year, and now it's I get 25% APR or something like that on futures curve or something like this. So it really just depends on how much kind of LTV you can get against some of these positions as well, right? Mm-hmm. So, but the thing is, for a lot of people, this isn't going to really become a major issue. I think Jordi's obviously probably, most efficient with his capital, or at least I hope so. Yeah. Better than me, at least.
We're paying 14% interest on loaned capital, so yeah, we have to exceed that.
Well, my assumption would be you're making well north of that.
Yeah.
15%.
Yeah. And then, so in terms of your holdings, right? And I don't know, it sounds like, Jason, you're fairly involved with your portfolio companies. What is your take on involvement in the protocol versus just passively holding?
The liquid ones.
All of it. Yeah, all the above. Like, I mean, if you're a large holder, so for example, do you participate in governance votes?
Yeah.
For a long time, the largest holders of MakerDAO didn't necessarily vote on governance proposals, and that was detrimental, I think, for, holistically for.
Yeah, I think there's a difference between public and private. Like, if we cut a check privately, I'm personally responsible for that founder, so I have to participate. We do a lot more work there. On the public side, it's no different than kind of, well, in my mind, it's like a share ownership. So we're almost leasing and renting the relationship in a way. And historically, I haven't really done much governance on the public side of things. In terms of help, I think a lot of it is coaching them on investor relations. A lot of them is sometimes putting them in touch with the right party. And we also do one thing, which is I run a podcast with them. I do introduce them to other liquid managers and say, hey, this is interesting. You should talk to the founder. But I think I'm doing a lot of investor relations work for them.
By the way, founders love Jason. They love him. Okay, just.
Well, thank you.
This is true. Yeah.
They love you too.
Yeah. So, and then even again, for you on the market making side, or people who are leveraging, maybe principal balance sheet capital, do you guys view protocol involvement or yield farming or airdrop farming as a legitimate strategy, or is it something that you guys would do? For example, would you guys be heavily involved in a new perp dex to farm, or is it really just about obviously you don't own ETH to stake it for 3%. You own ETH for the 150 vol asset class asset that it is. But what's your take on airdrop farming or otherwise?
I mean, there's stuff that is very good for individuals to do that we don't get involved in. Like airdrop farming is a good example where it's just it's not something that I want to spend a lot of time trying to do at scale.
Yeah. Do you guys run up nodes on projects that you're involved in, or?
Rarely.
Really?
Yeah, we're trying to add value less on running nodes and farming airdrops and trying to just strategize with them, and it's a hard industry. It's very competitive. There's 100 projects for each category. Each category has so many founders, so many builders trying to compete for that exact same vertical, and maybe the vertical is dead. I generally tell founders that don't worry so much about your competitors. Just worry that the vertical will actually be a thing, and then you can compete for it later.
I mean, in those, it's less than zero sum because the vertical's declining as their position could be declining within it.
Yeah.
Yeah, it does feel like for the last 2 years, maybe it's changing slightly, but for the last 2 years, it was really a zero-sum game across the board. So, you weren't seeing a broad-based rally up until more recently. We've seen more market breadth, but for a while it was, if all L1 is running, it's because another is being, sold down to generate cash to buy that asset in the book. You feel like that's evolved a bit, or you think it's still pretty zero-sum? I mean, that just matters of flow of funds into the space, but what's your take?
I think the biggest thing here is one fundamental miscalculation I made, and I'll be very honest about this, is that back in 22 and 23, my assumption was that, more so 23, equity market performance would drive capital into crypto, and that was a horrendous kind of take because equity market returns have very little to do with new capital coming into crypto. Actually, what matters is interest rates more than anything else, right? So you're not going to get private fund deployment. You're not going to get net new buyers of long tail crypto assets, i.e., anything outside of Bitcoin, except in a market where people are so risk tolerant that they will deploy money on anything without DDing, right? So, I mean, Mike, this, back in 21 or 2020, you could get a call with an investor and, they would turn around and send you $5 million and it would not even be a thing, right? Now it's like a 6-month process. You have to talk, it's a whole, and so that's a big reason why we're not seeing asset valuations kind of stabilize for a lot of assets outside of, hey, this narrative is hot for Sui because they have some Pokemon, something or another, or Avalanche or whatever, and then cyclically we'll do one of these, right? Yeah. So I think it's much more to do with the fact that there's just not enough private capital demand that's coming in to bid this stuff.
Yeah, and there's enough spivvy equities for people to get their vol dose in small cap or micro cap equities, right? I mean, even in our world, right? You have the new Solana treasury assets that are $20 million stocks that are trading hundreds of millions of dollars in volume and ripping 5x in a day. That kind of pulls away some retail from the funkier stuff in crypto.
Yeah, I think to that point too, right? Like now, a few years ago, it was this thesis that Coinbase would become this like mega, institution, and it has become that. But I think we have to ask ourselves the question of maybe there's just a handful of assets within crypto that will kind of port over to TradFi, right? And be on TradFi interfaces like IBKR or Robinhood or what have you. And the universe of investors probably does not want to like trade dog money and cat money in perpetuity, right? So that's like kind of the reckoning that we're coming to at this point.
Which companies will graduate? I mean, Bitcoin did, and then Solana is on its way there. Like, is there a long tail asset that you think would graduate?
I think we're finding this out in real time, right?
Yeah.
And like, if you look at, in my opinion, the ones that will graduate are the ones that are mostly focusing on that route, right? They kind of see it. All the ones that are kind of doing these like soul strategy, this, that, and the third, pushing the ETFs, whatever it is, they have massive foundations with hundreds of millions, billions of dollars in capital. The people running these foundations are not crypto people on average, right? They come from TradFi, they come from the hedge fund universe. They're positioning themselves in a way to get to that, mainstream outlet, right? Much more so than focusing on like, what's, going on in the meme coin market. They still do that on like at the periphery, but it's not the core focus anymore.
But how do you feel about those assets that are basically a pseudo equity? Like there are stocks that are doing massive buybacks, like Hyperliquid. Do you feel like that class that is, I mean, depends on what the SEC says about it, but like, do you think that will ever graduate?
I mean, Hyperliquid is like kind of N of one asset in a way, right? Where it's like organic flow, kind of one on its own, doesn't have insane incentivization between different parties, and I think that's also why it's angered a lot of existing kind of big players, right? So that might become one of the model that a lot of people are pushing, which is actually really good because now, I'm sure this is the case for all of you guys, a lot of the portcos that you guys probably deal with are looking at Hyperliquid and being like, maybe I should go down this route of doing as close to a fair launch, as close to a, giving out a bunch of tokens to the community, not gatekeeping, not putting on a bunch of investors on the cap table. And so I think that can become the graduating factor.
And so I guess we'll get to the title of this panel, which is Navigating Crypto's New Regime. Take it however you guys want. I want to hear a little bit about how you feel about the new regime. You could talk about Trump, you could talk about AI agents, you could talk about whatever you'd like. But what is the new regime to you, and how are you navigating it?
Yeah, I mean, the big categories you just mentioned. So AI agents are, I talked to a lot of the AI luminaries, and they are saying that, this year and going into next year, there's going to be a lot of transformational technology coming on the AI agent space. And I'm firmly in the camp that crypto has a role to play in this in many different ways. And
specifically,
I mean, AI agents obviously need some form of money. Like, we don't understand how important money is, but money is like the portal between the AI world and the human world. It's the only thing that kind of, you can especially digital money. It has to be digital money. It has to be permissionless money, ideally. Not necessarily, but ideally. That's the end game. Is like ideally, instead of US dollars that can be censored, like it's a permissionless money. So extreme focus on that category. Obviously, a lot of the crypto tokens that will do well, remain to be seen what's going to exactly like play into that. It might be a lot of things that don't exist yet. And then, of course, Wall Street and the administration in the US, there's a lot of openness now for experimenting with different things, and some of them might work, some of them might not work. You could say like throwing everything at the wall and like something might stick is okay. It's a lot better than what we had going on a few years ago. So trying to be opportunistic and choosing the right ones there. I think it's a little bit trickier. I wouldn't say it's as clean there. And yeah, generally like the biggest alpha remains the same. It's just like buy dips when everyone's just like super panicked and be able to try to buy. Yeah.
I think of the asset in three segments, the liquid side. Like Bitcoin graduated. It's going to chop, but there are obviously religious buyers that will just keep buying it as a proxy digital gold. I think it's probably OK long term. The large cap betas, the layer ones, I think they are both a fintech equity and a currency to participate in the underlying wealth effect. If there's no wealth effect, and by the way, the wealth effect driver is way bigger than the fintech itself, the equity itself. So there's no wealth effect to go down. If there is, it just pumps. Subject to QE. I think it's OK risk reward, to be quite honest. The long tail of assets, I think there are maybe 10 to 20 that are actually investable. The founders are not complete scams. They care about token holders. They're actually building a good business. The rest of them just slowly bleed to zero with no mindshare. I agree with Jordi's point that there are a lot more potentially good businesses that are being built because it's no longer taboo. But those businesses are potentially fintech equity businesses that retail won't have access to. So I think fintech equity in the US might get a bid as VC investors. I think we're going to see some really good experimentation with stablecoins all over the world. And then I think the experiments with crypto-native entertainment products would be the one something that Align style of the world would keep on capturing. So for us, it's kind of focusing on the long tail and maybe have a pretty big Bitcoin allocation as the counterweight.
Bitcoin, stables, and entertainment.
Yeah, pretty much.
Stables for entertainment, Bitcoin for long-term holding. There we go.
Yeah, I guess to talk about the new administration, I think we're at a very weird point of time. As on one side capital allocators, on another side crypto, on another side being at the cutting edge of finance in a way. But I think we're at this point now where people don't they've heard for years we're going to get regulation, but it's actually happening now. And people don't really know how to think about it, and so now there's this mad rush to DC and New York and whatnot to kind of figure out what's going to happen in the stablecoin bill, either Stable Act or Genius Act, or the market structure bill that's happening right after this. So, truthfully, this is a lot of just uncertainty around what the space will look like in 3 years' time, because we're going to get some amount of regulation across the board on all these assets, all the instruments that we trade, the venues that we trade on. So that's going to be kind of the focus going forward for, I think, a lot of capital allocators. And to Jason's point, there have been some assets that have graduated. So broadly speaking, Bitcoin will not be in the kind of same universe of consideration as some other crypto companies or tokens or whatever, right? So this is already kind of in its own universe. It's then had 600K BTC on IBIT alone, right? For example. So that's in a category of itself. But I think people need to start really thinking about what the space will look like when it's actually regulated by U.S. regulators, and how much of a force that will have on everyone here, everyone in Europe, right, and broadly the rest of the world.
So Bitcoin's the new tier 1 capital.
And by the way, the beta might not be layer ones. It could be like Robinhood or Stripe or those fintech stocks.
Yeah, that'd be interesting as more companies come public over the next few years, if that even consolidates further the crypto native assets that people are willing to hold as the basket gets more equal. Okay, great. Well, gentlemen, thank you very much for sharing your views and talents with this room. And if anyone wants to reach out to them, ping them all on Twitter. They're pretty active. Thank you, everybody.